3 a.m. in Geneva, a man in a wool coat walks briskly through the rain toward a building made of stone and silence. His name is Peter Gygax, a bank clerk, middle-aged, unremarkable. He has worked at the Banque de Genève for 19 years. He knows every account, every ledger, every number. And tonight, he knows something nobody else does yet. Meanwhile, across the city, a factory owner named Hermann Detley sleeps soundly in his villa. He has 40,000 Swiss francs in that same bank. His children's education, his retirement, his entire life, stored in a building he trusts completely. By morning, that building will be empty. Not robbed, not destroyed, just empty, in the way that matters most. And Hermann Detley, who did everything right, will wake up to nothing. Here's what nobody told him. Here's what nobody tells us. The bank was never holding his money in the first place. We are taught something from childhood. We put money in a bank. The bank holds it. We take it back when we need it. Simple, safe, logical. But that's not what banks do. That has never been what banks do. When you deposit $10,000, that money doesn't sit in a vault with your name on it. The bank lends it out, immediately, to 9 other people. Your $10,000 becomes $90,000 in the economy, through a process so routine, so legal, so encouraged, that we don't even question it anymore. It's called fractional reserve banking, and it means that at any given moment, the money you think you have doesn't fully exist. Not in physical form, not in accessible form. It exists as a promise. And right now, in 2025, the promise is under more pressure than it has been in decades. This is the story of the silent collapse happening inside banks. And it didn't start recently. It never really stopped. New York City, March 1933. It begins not with a crash, but with a whisper. Someone hears that their bank is struggling. They tell a neighbor. The neighbor tells 3 more people. By the next morning, the line outside the American Union Bank stretches around the block. Everyone wants their money. Right now, today, the bank opens its doors. It pays the first 100 customers. Then the next 50. Then it runs out. Because here's the brutal arithmetic. For every dollar deposited, the bank had lent out 8 more. When even 12% of customers show up at once, the vault is empty. This is a bank run. And the terrifying part isn't the run itself. The terrifying part is that the bank was considered healthy the week before. It had good loans, strong assets on paper, respectable management. But paper assets don't pay a man who is standing in front of you demanding cash. Between 1930 and 1933, over 9,000 American banks failed. Not because they were fraudulent, because they were fragile. Because the entire system is, by design, fragile. This is the first law of modern banking. A bank is only solvent as long as nobody questions whether it's solvent. The moment confidence breaks, the math stops working. And here's what history shows us about confidence. It doesn't erode slowly. It doesn't give warnings. It disappears overnight. After the Great Depression, governments made a promise. In America, the FDIC was born, the Federal Deposit Insurance Corporation. Your deposits are safe. Roosevelt effectively told the public, up to a guaranteed limit, and it worked brilliantly as a psychological tool. Bank runs nearly vanished for 50 years because people believed the net was there. But here's the part nobody tells you. The FDIC currently insures trillions of dollars in deposits. Its actual fund has held at various points less than 1.3% of those insured deposits. 1%. Meaning, if a large enough wave of banks failed simultaneously, the insurance fund itself would be overwhelmed in hours. This is not a conspiracy theory. The FDIC has publicly acknowledged this math. It's built into the system's assumption. Not everything fails at once. But we've seen what happens when that assumption breaks. Cyprus, 2012. Cyprus was a small country with a disproportionately enormous banking sector. Its banks had absorbed billions from Russian oligarchs and European investors. The banks bet those funds on Greek government bonds. Greece defaulted. The banks collapsed. And the European bailout that followed contained one historic clause. For the first time in modern European history, depositors themselves were asked to take a loss. Not shareholders, not bondholders first, or depositors. People who simply had their savings in an account woke up one morning to find a percentage had been legally seized. It was called a bail-in. The world barely noticed. But inside banking circles, it changed everything. Because it proved something previously theoretical. When the losses are large enough, your deposit is not protected. It is collateral. We need to talk about what's happening right now. Not in 1933, not in Cyprus. Right now, in 2023, Silicon Valley Bank, the 16th largest bank in the United States, collapsed in 48 hours. Not in a recession, not during a market crash, during a period of relative economic stability. What happened? SVB had done something banks aren't supposed to do. They concentrated. They held an enormous portion of their assets in long-term U.S. government bonds. These are the safest assets in the world. But safety and liquidity are not the same thing. When interest rates rose rapidly in 2022 and 2023, the value of those bonds dropped. SVB was sitting on billions in unrealized losses. A few large depositors found out. They pulled their money. Word spread not through newspapers or television, but through private group chats. Venture capitalists advising their portfolio companies to move funds now, tonight. Within 24 hours, $42 billion had been withdrawn. By the second morning, it was over. Here's what should disturb you deeply. After SVB's failure, the Federal Reserve quietly conducted stress tests on other regional banks. The numbers were not released fully to the public. What was released revealed that hundreds of U.S. banks were sitting on unrealized losses totaling over $600 billion. On paper, healthy. In reality, one crisis of confidence away from SVB's fate. This is the second law. The losses are always there. The question is only when and if they become visible. But wait, we need to stop here. Because everything we've covered so far, bank runs, bail-ins, unrealized losses, that's only the surface. There's something deeper, something that makes all of those crises look like symptoms rather than the disease itself. And almost nobody talks about it publicly. Not because it's hidden, because it's boring. Because it lives in the language of derivatives, repo markets, and off-balance sheet vehicles. The world's largest banks are not primarily in the business of holding deposits anymore. They are in the business of complexity. Japan, late 1990s. Japan had the second largest economy on earth. Behind closed doors, those banks had spent a decade making bad real estate loans. When Japan's property bubble popped in 1991, the losses were staggering. But instead of writing them down, they kept the bad loans on their books. They called them zombie loans. Why? Because acknowledging the loss was worse than pretending it didn't exist. This strategy bought time. It also bought Japan a lost decade. Fast forward, America, 2006. Wall Street had invented a new class of financial product. Mortgage-backed securities, collateralized debt obligations, credit default swaps. The complexity was deliberate. These instruments were so convoluted that even the people selling them couldn't fully model the risk. They were rated old AA, the safest possible rating. They were catastrophically unsafe. When the housing market turned, these products didn't just lose value. They became impossible to price. And when nobody could price them, nobody trusted anything. The global credit system froze. September 2008, Lehman Brothers files for bankruptcy, the largest bankruptcy in human history. And the global economy nearly stopped breathing entirely. Here is what the 2008 crisis revealed. The banks most people trusted were not the banks actually running the show. Behind every major bank is a shadow, a network that exists adjacent to the regulated system, larger than the regulated system, less visible than the regulated system, almost entirely outside the protections that the regulated system provides. This is the third law. Every financial crisis in modern history has been amplified, if not caused, by the parts of the system nobody was watching. Here's where we are in 2025. Interest rates rose faster between 2022 and 2024 than at almost any point in 40 years. That rapid rise created an environment designed to stress the banking system. Bonds lost value. Commercial real estate collapsed in many markets. Office vacancy rates in major U.S. cities hit 30%. Banks hold hundreds of billions in commercial real estate loans. Those loans are coming due. Default is the only option. But here's what banks are doing right now. They are extending those loans, rolling them over, granting forbearance, calling it something else. The industry term is extend and pretend. At the same time, deposit competition has intensified. Money market funds now pay 5%. Why would you leave money in a checking account earning near zero? Millions of people don't. The quiet movement of money has been one of the largest silent bank runs in history. No panic, no lines, no drama. Just people making rational decisions, one click at a time. This is the fourth law. The most dangerous bank run will not look like 1933. It will look like a software update. Now let's connect the thread. Every time, the same architecture produces the same result. Confidence is the only thing standing between a functioning bank and an empty vault. Modern banking is not fundamentally a financial system. It is a belief system,